Example 6, financial analysis example. Use the financial statement information and disclosure provided by MU in Exhibit 2, 3 and 4 to answer the following equations. MU discloses a valuation allowance of 2,321 million, gross deferred assets of 3,782 million in 2017. Thus, does the existence of this valuation allowance have any implication concerning MU's future earning prospects? Now, first of all, we need to understand. Now, deferred tax asset is used to lower taxes for profitable companies. So when the company is profitable, deferred tax asset can be used to lower taxes. Now, if the profitability is low or you don't see any profitability in the future, so there is no point of having deferred tax asset. So deferred tax asset won't be used to lower taxes, because when the company is not profitable, the company doesn't pay any taxes. So when there are no taxes, deferred tax asset cannot be used. So if in the future the profitability is low, so there is no benefit of deferred tax asset. So deferred tax asset is reduced by a contra account that is known as valuation allowance. Now, as valuation allowance increases, deferred tax asset goes down. Now over here in this example, according to the Exhibit 4, MU's deferred tax asset expire gradually until 2037. So there is a time frame of deferred tax asset. So deferred tax asset can be used for a time frame. Beyond that, deferred tax asset cannot be used. Now, if you see that there is no profitability in the future, so there is no point of having deferred tax asset. So we increase valuation allowance, that is your contra account, and we reduce deferred tax asset. Because the company is still relatively young, it is likely that most of these expiration occurs towards the end of the period. Now, we also need to understand, for this company, there is a operating loss carry forward of total 3.88 billion. So there is a loss of 3.88 billion. Now again, in losses of 3.8 billion, there is no benefit of having deferred tax asset. Now the valuation allowance could imply that MU is not reasonably expected to earn 3.88 billion over the next 20 years. So if you are not able to earn more than 3.88 billion, we are unable to reduce our taxes by using deferred tax assets. However, for this particular company, if we see Exhibit 2, MU earned a profit for 2017 and 2015, and actually there is a good sign, because we can use deferred tax asset to reduce our taxes. Now, if the profitability continues in the future, then deferred tax asset can certainly be used to reduce our taxes, and the valuation allowance would go down, thereby showing that the allowance could be adjusted downward. So valuation allowance can go downwards if we are able to use deferred tax asset. If the company continues to generate profit in the future, and making it more likely than not that the deferred tax asset would be recognized. So if we are profitable, it will be more likely that we will be able to use our deferred tax asset. How would MU's deferred tax asset and deferred tax liability be affected if the federal statutory tax rate was changed to 21%? Initially, the tax rate was 35%. If it is reduced to 21%, deferred tax asset and deferred tax liability both will go down. MU's total deferred tax asset exceeded total deferred tax liability by 749 million. So deferred tax asset was more than deferred tax liability by 749 million. A change in the federal statutory tax rate of 21% from the current rate of 35% would make these net deferred tax asset less valuable. So both deferred tax asset and deferred tax liability would go down as your tax goes down, tax rate goes down. Also, because it is possible that the deferred tax asset valuation allowance could be adjusted downwards. Now, in the last example, or on the first part, we said that if the company is profitable, we can reduce valuation allowance and can use deferred tax asset to reduce our taxes. So as we said in discussion into solution 1, we might reduce our valuation allowance, so in order to use deferred tax asset. So it is possible that the deferred tax asset valuation allowance could be adjusted downwards in the future. The impact could be far greater in magnitude if the tax rate goes down. How would reported earnings have been affected if MU were not using valuation allowance? Now, your income tax provision or your income tax expense equals to income tax payable plus change in deferred tax liability minus change in deferred tax asset. Now, if we increase our valuation allowance, that is going to reduce our deferred tax asset. If deferred tax asset is reduced, our income tax expense or income tax provision will go up. Now, the disclosure exhibit 4 shows that the increase in the valuation allowance increased the income tax provision as reported on the income statement by 64 million in 2017. Now, this is quite true. Now, increase in valuation allowance would going to reduce deferred tax asset. If this part goes down, this expression will increase and hence income tax expense will also increase. Additional potential reduction in the valuation allowance. If valuation allowance goes down, your deferred tax asset will increase. If your deferred tax asset increases, then this portion would go down and hence income tax expense or income tax provision will also go down with it. So additional potential reduction in the valuation allowance could similarly reduce reported income taxes. So we have seen that the income tax expense would go down if deferred tax asset goes up. So if deferred tax asset goes up, this whole expression will go down and income tax expense would go down with it. How would MU's 3.88 billion in net operating loss carried forward in 2017 affect the valuation that an acquiring company would be willing to offer? So if a company is trying to acquire a company which has a 3.88 billion loss, so this company might be profitable. So by acquiring this company, they can reduce their taxes. So if this company has high tax rate, so the tax advantage would be even more profound. So if an acquiring company is profitable, it may be able to use MU's tax loss carried forward to offset its own tax liabilities. The value of an acquirer would be the present value of the carry forward based on the acquired tax rate and expected timing of realization. The higher the acquiring company's tax rate and the more profitable the acquirer, sooner it would be able to benefit. So if the company is more profitable, it has very high profits and the tax rate is also high, acquiring company which has a $3.88 billion loss would be quite beneficial and it will going to reduce its taxes. Therefore, an acquirer with a high tax rate would be theoretically be willing to pay more than the acquirer with the lower tax rate. Under what circumstances should the analyst exclude MU's deferred tax liability from both debt and equity when calculating the debt to equity ratio? So, the analyst should classify deferred tax liability as debt if the liability is expected to reverse. So, when the liability is expected to reverse, analyst should classify the deferred tax liability as debt if the liability is expected to reverse with the subsequent tax payment. If your deferred tax liability is not expected to reverse, there is no expectation of cash outflow and the liability should be treated as, so if it is reverse, then we can keep it as our debt. If no reverse, then it will be equity. And in the end, if the timing and the amount of cash flow is not known, so the deferred tax liability should be excluded from both debt and equity when both the amount and timing of tax payment resulting from the reversal of temporary difference are uncertain. So if we are uncertain about the amount and timing of tax payment, then we will not include them as debt or equity.